Exiting your practice or your business is not only the biggest financial transaction of your life, it may be one of the biggest decisions that you make in your life, and you don't get a do-over. Look, there is a long line of people that have exited incorrectly that left a lot of time and a lot of money on the table. Don't be one of them. If you want to exit out at the top of your game, if you want to exit out with a pile of dough, stay tuned in this episode and we'll show you how. I'm on a mission to help 200,000 practice owners achieve financial freedom. I'm Eric Miller, author of How to Become a Financial Beast. Download my free book today, A Practice Owner's Guide to Personal and Business Wealth You Never Thought Possible. All right, everyone, welcome back to the Financial Beast podcast. I'm your host, Eric Miller, co-owner, chief advisor at Econologics Financial Advisors, along with Mr. Eric Gertz, financial advisor extraordinaire. In case you don't know, we help healthcare practice owners and associates elevate their financial experience through the premier financial advice that we give every single day. Make sure you guys check us out at econologicsfinancialadvisors.com. And a reminder, if you're brand new, please, hey, give us a like, give us a share, and make sure that you subscribe to the channel so that we can continue to do these awesome videos that we love to do so much. So, all right, man, tis the season, isn't it?
It is.
Tis the season that people call and say, is this the year that I am going to exit out?
Sales season.
So everyone starts looking at their stuff, new unit at a time. Man, I don't know. Are we getting close?
Is 2025 the year?
Is 2025 the year? Or, as Josh just had a client that was just like almost fed up to the point where she's actually called a corporate entity and was like, hey, what's a joint venture look like again with you? So we just thought we would go over some of the things that we want to make sure you guys look out for, prepare for, and that way when, you know, the idea of selling your practice or your business comes up, you know exactly what you're supposed to be doing and who you're supposed to be talking to. Number one, make sure you have an advisor that you're working with. Okay. A financial advisor that understands exit planning. Like, I can't emphasize that to you enough. Most of the advisors out there are going to just tell you, yeah, sure, sell your practice, because they're just looking at all the dollars that they're going to get to invest.
Yep.
Okay. That is the worst thing you can do. All right. So make sure, number one, that you have someone that understands exit planning, has experience with clients exiting. What are we at right now as far as how many people have exited?
At least a few dozen.
Oh, dude, I thought it was like 50 or 60.
Yeah, that's what I mean. I mean,
yeah,
it's probably, if I had to guess, I'd say it's probably about 50.
Yeah,
I'll have to go back and update. I have that spreadsheet, but
yeah, we kind of keep that up to date just because it shows us like this is where the person is, this is where they were, and this is what they sold for. So, you know, first things first. You know, and we say this a lot. Like, if you're to the point of burnout, like, I would not sell my business in that condition, just because it's likely there's a reason why you're burnt out, because you're probably doing all the work. You're probably having to handle all the responsibilities.
yes.
And the money's not coming in to reward you as much. So your profits are down. So, I mean, would you want to pay top dollar for something like that? I wouldn't. So if you're interested in getting a good valuation, try not to sell when you are in a, what's a good term? Desperate state of mind.
I like that.
You know, like a desperate state of mind.
Yeah, because I think, you know, I don't think, I know when people are burnt out, they're more than likely not going to do a very thorough job in their sale anyways. They're not going to get multiple offers. They're not going to make sure they're getting paid fair. They just want to get across the finish line by any means necessary.
Yep.
And it's going to cost them money 9 times out of 10.
Yep. It's going to cost a lot of money. So I think that's the first rule of exiting, is just never, ever, ever make a decision when you're in burnout. Yep. So that's just the wrong thing to do. Second thing is that you got to determine, again, we call it the emotional readiness and the financial readiness of exiting out. So emotional readiness, I think we talked a little bit about that, but it's more important, like, hey, I'm kind of done with the game, and there's something else I want to do.
Yeah. What is it?
Yeah. And a lot of people don't really, and if it's just, I'm going to tend to my horses, or I'm going to, spend time with my grandkids. Okay.
Those are probably not going to be enough, though.
No, I mean, you guys
got to say that, but it's true. I've seen it.
Yeah. I mean, you got to remember, man, when you're in ownership mode, well, it may not seem like it, but your mind's going 180 mile an hour all the time. Did we forget about this? What about this? What about did we, are we doing this? Are we marketing? Whatever it is. Like,
you're always thinking about what you could do, what you should have done and what you can do better.
Yeah. And when you're doing that, obviously your mind's going and you're like, okay, now when all that goes away, then what? Now what are you thinking about?
It's like hitting a brick wall.
Yeah. I mean, it's going to mess with you. And I think you've probably seen that happen to some people, haven't you? Where, like, I think I've seen that where people have stopped, and like my next conversations with them, I can noticeably tell that they're mentally not as aware as they were.
Yeah, I mean, I've seen people. I think when people sell, there's always there's that initial honeymoon phase, right?
Yeah.
Everyone loves those first few months. But then once the excitement wears off and it's just normal, that's where it really hits people. Like, I don't feel useful.
Yeah.
I just kind of wake up, do my thing, go to bed. I don't feel fulfilled. There we go.
Yeah. No, that's pretty big, because when you look at, like, if you looked at like an emotional scale where, at the high of it, you're in, like, you're enthusiastic, you're positive, you're cheerful, and you look at the low of it where you're like in despair, being useless is like one step. I don't know if it's one step above death. It's not very high.
No.
Is it? So
no, it's not where you want to be.
And you look at some people like in that are in like last stages of their life. That's where they're at. They can't function. They really can't do anything physically. They're just kind of useless, and they know it. And I think that's what probably ends up, putting them into the, where they say, that's it. I don't want to live anymore.
Yeah.
So, don't give it a head start. You're going to get there one day, but
right.
Don't give it a head start.
Let's not speed it along.
Yeah, we don't need that. So you guys have to find out what's purposeful and where you're useful.
Yeah.
And so you have to make sure that you fill up the void of what you were doing, because if you own a healthcare practice, man, I mean, how many patients are you guys helping a day?
Yeah.
I mean, it's hundreds of people that you're helping a day. And while you may not hear about all the or all the great outcomes and everything like that, I mean, just know that you're doing it. Know that you're doing
that. I think that's why not everyone, but most people go into healthcare to begin with. They go into it because they want to help people.
Yeah. So it's like, hey, man, this is like what we're doing. And all of a sudden you're not part of that anymore. That's going to mess with you. So you guys have to replace an activity with an activity of comparable magnitude, or, you're not going to be, as happy. You're not going to be as fulfilled, whatever it is, and you're not going to be as useful. And that's no bueno. The second thing is, of course, your financial readiness to be able to do that. So first things first, when you sell your practice, I got news for you. The money that you're making from the practice, okay, you're never going to get that same amount on the sale proceeds. All right, I'll say it again. The amount of money you're making from the practice during ownership, you are not going to replicate that income stream just on the proceeds alone.
No.
Okay. So give me an example of that.
Yeah, I mean, like,
let's say you make... Give me a $2 million practice at a 20% margin.
Okay, $2 million practice, 20% margin, you're making $400,000 a year.
Yeah.
Right. You take that $2 million practice, I don't know, let's say you sell it for...
So let's say you sell it for $4 million.
$4 million. That's actually the number I was going to use.
Yeah.
So you've got $3 million after taxes at 25%, let's say.
Yep.
And we'll even say that you have no debt.
Yeah.
If you do have debt, that has to get paid off. But let's say you have no debt and you walk away with $3 million all said and done.
Yep.
At a 5% withdrawal rate.
Hey, let's say that you're even making 7% on that money.
Okay. Let's say a 7% withdrawal rate, which is crazy, by the way. Yeah. No one should do that unless you're like 85. It's $210,000 a year.
Yeah.
Your income's cut in half right there.
Yeah. Now
and look, that's at a 7%, which isn't even realistic.
Yeah. So, and now look, are things good at I mean, the $400,000 profit that you show on your business, I know you guys aren't all taking that home and spending that, right?
No, it goes to debt, taxes, working capital.
But just realize that, I mean, $2 million practice selling for $4 million is that's a pretty good sale. Like, a lot of you guys aren't going to get that amount.
No.
But some may, but even then, it's still not going to replace the amount of income that you make. So you have to make sure along the way that you set up a friggin' system of building other income sources, whether that's owning your building, whether that's, putting money in a stock and bond portfolio, real estate, insurance, whatever it is. Okay.
Yeah, you just have to build wealth over your career. You can't just rely solely on the sale of the business to take care of you.
Yeah. You just can't do it. So you have to make sure that you have a system set up. That's one of the things that I think we do better than anyone else, is to show owners and even associates how to make sure that they have a system of saving to invest.
Yep.
Okay. And then that way that, when you decide that you want to sell, you can start looking at everything now. Okay, great. So if I sell, this is what the proceeds money is going to provide me. By the way, I have my building right here that's going to provide me this. Oh, by the way, I have my retirement accounts that are going to provide me this. Oh, by the way, I have these other assets and things that are going to provide me this. And ideally, we should be able to replace, I don't know, almost 95% of your income, 90 to 95% of what you're making right now.
Oh, absolutely.
In some cases, it's almost the exact same amount. And if you do that, you're actually going to feel richer, because you're not going to have the same, probably not the same tax liability. You're not going to have the same overhead payments. You're not going to have the same debt payments. And
yeah, I mean, it's possible to make less but make more.
Yeah, because you're also not going to be saving like you were.
Yeah,
when you own the practice. Okay, because we're having people save 10% of your practice revenue, which kind of equates to like 25 to 30% of your take-home pay, which is an enormous amount of money. Okay, but that's how you do it.
Yeah, I had someone yesterday. Actually, it's funny you say that. I had someone yesterday whose savings ended up being about 80% of their annual profit.
Jeez, that's crazy.
Yeah.
Wow. That's crazy. We don't
That's not the norm,
but we don't expect everybody to do that, by the way.
No.
But if you can do that, you're going to be able to have the money game licked pretty quickly. That'd be great. But man, I'd take 40. Yeah. I mean, obviously, whatever, that's a big percentage right there.
Yeah.
But anyway, so those are the two things, obviously, we got to make sure that are in place. So you're emotionally ready, and then you are financially ready. Okay, so I got those things in place. Okay, I'm not burnt out. I got the emotionally, I know what I'm going to do. Financially, I'm pretty well set. Okay, great. Now what? Now what am I looking at? Well, now we have to start like getting into, okay, let's see what that practice is actually, what are the valuations that you're getting in your industries right now?
Yes.
So, all right. And then what's the method in which you want to exit out as well? That's the next thing I was going to say. Like, how do I want to do this? How do I want to do this? All right. So you have options of how you can exit out of your practice. I think the three most consistent ones I've seen, you could sell to an associate.
Yep.
You could sell to a competitor. You could sell to private equity.
Yep.
Right?
Yeah, that's
pretty
98% of sales right there.
Yeah. So
for us, at least
for us. I mean, there's other ones which are, outside the scope of healthcare businesses. I mean, there's like ESOP plans, and then there's
but for the people that we're dealing with, there's a 99% chance you're going to sell to one of those three.
Yeah.
Or the fourth, although I am getting a couple of these now. And this, I guess this isn't all that similar or unsimilar to selling to an associate, but one that I'm starting to see now, I just had two people bring this up in the last couple months, is they have kids that are becoming, doctors just like they are in the same field. And the kid's going to take over the practice and pay them out of the profits for the next 15 years.
Yeah. I mean, that'd just be an internal family sale.
Yep.
Which you could do. And a lot of people want to do that as well. I mean, obviously there's pros and cons to all these different strategies right here.
Oh, yeah.
And I don't think I want to get into like the pros and cons.
No, we could do a whole half hour just on that.
Each of those, but just decide which one that you want to do. Now, I will tell you, if you want to get the most money and probably private and the fastest amount of money quickly, it's probably going to be a private equity deal.
Corporate private equity. Yep.
All the other ones are going to take a little bit of time to get established. You're most likely going to have to carry or do some seller financing in most of those deals. You're going to have to stay on for a period of time, depending upon how much involvement you have in the production of the practice as it stands. In most cases, so those are just some pretty much non-negotiables that you're going to have to just ante up to. So, but that's the next thing is like, okay, how do I want to exit out? All right. And then I think from there, we just, you have to start then saying, okay, do I have a practice that someone would want to pay max value for?
Yeah.
And now you have to start internally looking at what makes a practice valuable to somebody else. So I think we've talked about this before, but we have a list of probably 5 or 6 things that are going to assure that you get a relatively good multiple.
Yes.
Depending upon the industry that you're in. Now, when I'm talking about industries, obviously there's different industries in healthcare. There's the medical industry, there's the like veterinarians, there's physical therapy, there's optometry, there's these different offsets.
Yes.
In the healthcare industry. So, and all of them are to some degree have the attraction of private equity in these industries right now, meaning that
private equity exists in all of them to differing degrees, but it is there in all of them.
Yeah, and in case you're living under a rock, basically private equity is private money and investment that forms management groups that go in and they try to buy as many practices as they possibly can to create a scenario where they can then automate it. They can, systematize it better, and then they can sell it to a bigger group.
Yep.
Called a recap. So that's this the basic of it.
That's the short of it.
Yeah, that's so anyway. So the idea that you could, so now you're just like, okay, well, how do I want to sell this thing? And then what's going to drive the most value? Now, if you're just money motivated, like you want to get the highest value sale. All right, well, here's some things you have to have in place. Number one, you have to have an EBITDA that is pretty high. Now, I'm going to say to really start qualifying for the upper echelons of valuations, it's probably got to be over $800,000 EBITDA, somewhere around there.
No, I would agree. I would say around 800,000, and doing that. I'm trying to think of how to word this. It's not just having high earnings alone.
Yeah,
it's having high earnings compared to other businesses of similar size. Like, let me give you an example. If you have say you do $2.5 million a year of business and you take home 800. The multiple on that is going to be much greater than someone who does $4 million in business and takes home 800.
Gotcha. Yeah. So they're still looking at the percentage as well of what your EBITDA is compared to the revenue.
Yes.
Okay. So like if I'm doing $10 million and I have and I'm doing 800,000 in EBITDA.
That's 8%. That's not very.
That's 8%. That's not awesome.
No.
So,
although, when you get into businesses that big, now there's room for improvement.
You're still going to get a good valuation for a business like that, just because you've evidently been able to duplicate the production where you're not doing it all by yourself.
Yes.
Okay.
Yeah.
Which leads into the next one, which is that, like, you have to make sure that you're not the only sole producer in the office. Now, look, I mean, I've seen some people get pretty decent valuations where they do like 80% of the production.
Yeah,
okay.
Yeah.
Happens, but you're just going to be stuck for a long time in that practice.
Yep.
Because they're not going to want you to leave. Okay.
No, if you're the only producer or the lion's share, they can't really replace you easily and quickly. So you're going to have an employment agreement for a number of years, probably 3 if you're lucky.
So ideally, man, I'd like you guys to get under like 30% of all the production. If you could get there, that's probably a better. It's better than 50, and it's certainly better than 80.
Yeah.
So
I mean, the short of it is the smaller the percentage of production that you do, the more freedom you're going to have once you sell.
Exactly. Yeah, you're not going to be expected to have to be there as much. You're not going to have to expect it to have to work as much. You still can, but you
still can if you want.
You'll just have a more flexible employment agreement, I think.
Yeah, no, I just went to lunch with some clients who sold a couple of years ago, and he's a doctor, but they, at the time that they sold, he, his production was like, I don't know, 3 or 4%, 5% of the practice. I mean, he didn't do much.
Yep.
And because of that, he didn't even have a zero employment agreement. They gave him a consulting agreement where they'll call him to come in and do some specialty surgeries.
Yeah.
But we're talking single digit hours each month.
Yeah.
Versus the majority of people in this field, the veterinary field, they're working for 3 years full time for the buyer.
Yeah.
I mean, it's night and day difference.
Pretty ideal, man. That's a pretty good situation he's got himself in right there.
Oh, he loves it.
Yeah, I'm sure he does.
He is very happy.
Yeah.
Happy to report that.
I can imagine he would be.
Yeah.
But, okay, good. So that's another one, that's going to give you, so we talked about profit margin, your percentage of your production being lower. All these things are just going to make your practice more attractive for someone to want to buy for a higher dollar amount. Certainly no compliance or legal issues. Clean that stuff up. Make sure that, no one's going to want to buy if you have infractions all over the place or there's lawsuits pending. You can forget about it. Okay.
No, and I think another good one that I've seen lately, well, not just lately, but is buyers want, especially corporate private equity, but they want to buy something that has future growth potential.
Yes.
They don't, if you're in your building and you're 100% maxed out already, they'll still buy the practice, but they're going to give you a very short-term lease because they know it's already busting at the seams. So we're not going to be able to stay in this location.
Yeah. They want the ability for increased capacity. Either that you could build out something or, do another location somewhere, start a de novo practice, all those things that, I think they're going to want to see because of that. So you do have to show that you're growing. Like if you're just going sideways or down, they're not going to like that.
Yeah.
Okay. That means you're getting lazy on your marketing or you're not getting good referrals or whatever it would be. But either way, you have to show that you're growing, increasing your growth.
Yeah, people want to buy a growing business. They don't want to buy something that's flatlined.
Nope, not at all. And then, of course, your people. You have to make sure that you have a core group of people that have been there that are going to, because obviously they need people that are going to produce and run the operation because they're not going to do it. Okay. They don't want to come in there and do that. They want to just keep the current team, especially if it's working.
Yeah.
And make sure that it's, coordinated and working together. And there's no there's not office drama. Like buyers hate drama. You just tell you that right now. So you're going to make sure that is at a minimal amount. But, these are the things that a buyer's going to want to look for. And if you guys can clean these things up in your own business, then good. You're going to qualify for a really, really good sale.
Yeah.
And if you don't, then, you're going to, it's not saying that you're not going to get a good value. You're just not going to get the best one that you could.
Exactly.
That's all.
Exactly.
Like, I don't want to give people it's either like all or nothing. There's a gradient in between. But, why not?
We want you to be at the top.
Yeah, we want you guys to be at the top. So anyway, I think that's good. Anything else you want to go over on that one?
No, I think that's good. Good for today.
All right, buddy. All right, guys.
Until next time.
Exit well, exit smartly.